All right, how's it going? Today we are going to be talking about a debt consolidation scenario, mainly because this has been coming up quite a bit over the last little while. So this specific family, they weren't really struggling. They had two good jobs. They owned their home. They paid their bills every month. Um, but there were some renovations. There was some life expenses, and they pretty quickly found themselves just a little tight at the end of the month, not quite what they were used to having, right? They had higher income jobs and they were used to having more at the end of each month. um and so what we did is we look at their entire picture. We say, okay, what are all your bills? So in this couple's scenario, um you know what, let's just dive into their current budget first. So they had a mortgage of about $757,000. um this is actually one extra zero in there. Uh, Closer to this. Sorry, I popped this in wrong. Uh-oh. No biggie. Okay. So they have about $757,000 on their mortgage. Um, that's the number we are thinking the house is going to appraise for. So their monthly mortgage payment was $4,600, about 63 $633 a month in property taxes. But the real cost happens here. So they've got a MasterCard, they've got a Canadian Tire Bank uh, Visa, they've got a Capital One Bank Visa, two Amex, a line of credit with a bank or a credit union, I should say. They've got a TD uh, credit card and their vehicle. All in, they're spending just over $2,000 a month on all this additional debt. So their total household payment each month was $7,300, and this is why they were feeling as tight as they really were. Um, it's not that they're not making enough, although there is a little bit to that. Um, they've just taken on some extra debt and would love to have a little more at the end of each month. So we looked at the entire picture. We said, what are our options? And one of them was for us to do a debt consolidation. So we had looked at lumping all of this higher interest debt together into a loan that carries a smaller interest rate, right? That's kind of the goal of this. And when we're looking at something like this, the couple said, we want to extend our amortization for as long as possible. So the way I tell people to think of an amortization is that's the length of a contract, and the term is how often you're renegotiating this. For this couple, they're expecting to be making a little more money in a couple of years, and they're expecting to come into some inheritance. So they said, right now, our priority is monthly cash flow. So we want to extend our AM as much as we're able to, and let's look at lowering this monthly payment as much as possible. So we looked at a lender that's going to allow for them to take on a 35-year amortization, right? So you see here, 35 years. We're looking at a 1 or a 3-year term. So the big thing to look at here are these closing costs and then the current liabilities, okay? So taking on a slightly larger mortgage because we've lumped some of this higher interest debt into this. We've accounted for an appraisal fee, some legal fees, and about $39,000 that are going to be paid out. So we're taking that high interest debt, the larger debt on the PC MasterCard, the second Amex, and the TD credit card, and we're lumping those all together and putting them onto the mortgage. In addition to this, we've got to account for a lender fee and the mortgage penalty to break their existing mortgage. This is all an estimate for them right now. That's why it's in orange, the mortgage penalty. Um, and then we look at what this would look like at the end of the month with their new payments. So their new monthly mortgage payment became 4126.57, right? And then we throw in $633 in property taxes. This couple, I actually think they pay their property taxes quarterly. For easy math, I always include this as a monthly budget line item. And now we've obviously cleared the Amex 2, the PC MasterCard, and the TD credit card, right? So they've freed up quite a bit in monthly obligations. Their monthly debts went from 2 grand down to $890, right? So their new household payment is 5650.38, and we freed up $1,649 for them each month, right? Let me just highlight that right there. 1649 each month that they now have to put towards whatever they wanted. So for this couple, there was a few things they wanted to do um, related to like family growth and investments and this and that. And this would be a perfect time for them to start doing something like this. Um, so we ended up pulling the trigger. We got to get the appraisal done. Boom, 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 and get the ball rolling on that. But this is a pretty quick and easy scenario on how powerful a debt consolidation can really be, right? They didn't know that if they lumped all of this together, they didn't really like think about it. They knew that this math would make sense. They've always heard a debt consolidation would free up the monthly cash flow, but they didn't know how powerful it would be and how much lower we'd be able to kind of get that payment down, right? And the big lever we end up pulling is taking the high interest debt, putting it into low interest debt, and extending this amortization out to 35 years. That's the biggest lever you could pull on is extending this out. The rates matter sometimes, but being able to extend this out, that's what makes the real difference. So if you have a scenario you'd love for me to cover, or you're curious what your scenario might look like, send me a message. We can chat. Hopefully, going to be putting more of these out here, and we can see how different situations shake out. Talk soon.